All right, let's dive into one of the most powerful yet kind of misunderstood engines of the global economy, the Collateralized Loan Obligation, or CLO. It's a trillion-dollar market that's basically hiding in plain sight, and today we're going to break down exactly how it all works. So why should you even care about CLOs? Well, for starters, how about this? They own a staggering 60% of all major corporate loans out there. I mean, that is a massive piece of the entire financial system. And look, we're not talking about some obscure companies here. We're talking about huge household names: Dell, Burger King, the Four Seasons. These giants, and literally thousands of others, depend on the money that flows through CLOs. So yeah, let's pull back the curtain on this thing. Okay, so what in the world is a CLO? The name sounds super intimidating, I get it. But stick with me here, because the main idea behind it is actually surprisingly straightforward. At its very heart, a CLO is just a big pool of corporate loans, and I mean hundreds of them, all bundled together into a single fund. But here's the key, the thing that makes it different. It's actively managed. You've got a manager in there constantly buying and selling loans, trying to get the best possible return. So here's maybe the easiest way to picture it. A special, totally separate company gets set up. It's called a special purpose vehicle, or SPV. Its only job is to buy up all these corporate loans. And you might be asking, where does it get the money? Well, it gets it by selling off slices of this loan portfolio to big-time investors. We're talking banks, insurance companies, and those slices are called tranches. And that brings us to maybe the most important concept you need to understand a CLO, the cash waterfall. It's a really clever piece of financial engineering that decides exactly who gets paid, when they get paid, and, crucially, who takes the hit if something goes wrong. So this is what that structure looks like. It's not just one big pile of risk. Instead, it's sliced into these layers, these tranches. Think of it like a pyramid, right? At the very top, you've got the super safe AAA-rated stuff. And as you go down the pyramid, each slice gets a little bit riskier, all the way down to what's called the equity tranche at the very bottom. So here's how that waterfall works when money is coming in. All the companies in the loan portfolio, they make their interest payments. That creates this big pool of cash. Then that cash starts flowing from the top down. The AAA investors at the top, they get paid first. Once they're all set, the money cascades down to the AA investors, then the A investors, and it just keeps going down the line. The equity investors, way at the bottom, they get whatever's left over. But here's the really brilliant part. For losses, the waterfall works in reverse. If a company defaults on its loan, that loss isn't spread out. Nope, it gets absorbed from the bottom up. The equity tranche at the very bottom takes that first hit. If the losses are bad enough to wipe out the equity slice completely, then they move up to the next level, the BB tranche. This is how the senior tranches are so protected. They have all these other layers underneath them ready to absorb any losses first. So you have to remember, a CLO isn't just this static thing. It actually has a whole life story with its own distinct phases, from the day it's born till the day it retires. It all starts in what's called a warehouse phase, where the manager is just gathering up all the initial loans. Then comes the reinvestment period. This usually lasts about 5 years. And this is when the manager is actively trading, buying and selling loans to juice the returns. And then finally, it goes into amortization. The trading stops, and all the cash coming in is just used to pay back the investors. Again, following that same waterfall structure, starting with AAA at the top. And this chart really paints the picture for you. You can see that first part, the ramp up, where they're buying all the loans. That's followed by that long, flat period. That's the active reinvestment phase. And then finally, you see that gradual slope down as the assets are paid off and the CLO winds down over, maybe 12 years or so. So because of that whole waterfall design, investing in the very top of a CLO is a totally different ballgame from investing in the very bottom. I mean, just look at the data. Okay, this table right here, this tells you pretty much everything. Between 1995 and 2019, a period that had the dot-com bust and the 2008 global financial crisis, the historical loss rate for CLO tranches rated A or higher was 0. Not a little, 0. Zilps. Even the riskier BBB-rated tranches did way better than corporate bonds with the same rating. Yeah, this quote from Western Asset just hammers the point home. Even when the broader market saw a ton of defaults, those senior tranches of CLOs have a perfect payment history. That is the power of that waterfall structure right there. And you know what? You could even argue they've gotten safer since the financial crisis. If you compare them to the pre-2008 days, modern CLOs have way more subordination. That's just a fancy way of saying they have a much bigger cushion of those lower-rated tranches to absorb any losses and protect the top. They've also got stricter rules on super risky assets, and they don't invest in other weird complex products anymore. Okay, so let's zoom out a bit from just one CLO and talk about their role in the bigger financial picture. We're talking about a market that is now worth over $1 trillion in the US alone. It's become an absolutely essential, critical source of funding that keeps a huge part of the corporate world up and running. Now, after the 2008 crisis, regulators really wanted to make sure that the people managing these things had more skin in the game. So new rules came out that now require CLO managers to invest a pretty big chunk of their own cash, usually about 5%, right there alongside all the other investors. The idea is simple, right? If the manager's own money is on the line, everyone's interests are probably going to be a lot more aligned. But here's the catch. For all their structural cleverness, these things are just immensely complex. If you want to analyze a single CLO deal, you've got to dig through this absolute mountain of legal and financial documents, the offering circular, the credit agreements, performance reports. I mean, the list just goes on and on. In fact, the complexity has gotten so intense that just having people do the analysis is hitting a wall. So to keep up, firms are now turning to artificial intelligence to read all these documents, pull out the key info, and help the managers make faster and hopefully smarter decisions. It's this really fascinating mix of old school finance and brand new tech. And that brings us to the big question, doesn't it? We've seen how incredibly resilient the CLO structure is and how vital it is for the economy. But we've also seen how insanely complex it is. So, are CLOs a stable pillar of modern finance, built on a really powerful self-correcting design, or is there a hidden risk buried in all that complexity that we just haven't fully wrapped our heads around yet? That's the trillion-dollar question to chew on.